We're here on the deck of the Swiss Re Pavilion in Monte Carlo for the 57th Annual Reinsurance Rendezvous. In a couple of minutes, we're going to be talking to Kurt Karl, Swiss Re's chief economist, and you'll find the talk very interesting. Well, we're sitting here on an absolutely gorgeous day in Monte Carlo, the blue sea, and we're fortunate enough to have with us Kurt Karl, the director and the chief economist of Swiss Reinsurance. And Kurt probably has forgotten more about economics than most people know, so I'm going to ask him, just in your opinion, Kurt, what are the trends economically? Are we coming out of the recession? Is it selective? What effect might this have on the insurance industry?
Sure, Charlie, and good to be here. We're looking at an improvement finally in Europe that looks like it will be long-lasting, not just a short uplift and down again.
Mm-hmm.
So we even saw some growth last quarter in Portugal, for example, but the big economies growing also, France and Germany. And the UK turning around quite robustly at this point, which is nice. The US has had slow growth, but it continues to grow, and it looks like it will be picking up quite sharply next year because it won't have the tax increases and the spending cuts that have been slowing down growth this year, weighing so much on economic activity. So the two parts of the world, Europe and the US, North America, that's about half of the world economy. So that looks like it's going to do well, and that's ongoing. Now at the same time, we've had the Fed say that they're going to taper off their purchases of assets. And this has been a big shock to emerging markets that have been relying on a lot of liquidity flowing across the global landscape and affecting particularly Asia. So this has been pulled back, and we've seen some big currency movements there and a bit of weaker growth and some current account deficits in India and Indonesia in particular. And these things are part of the process of unwinding from a very low interest rate environment, lots of liquidity, to a less liquid and higher interest rate environment. So bad news for the insurance industry in the short run on the interest rates because we're still investing into low returning yields, but it'll get better. So that's the good news part of that. And the growth will help premium growth. So that's also good news for the insurance industry. But it won't be such robust growth as we had been hoping for out of the emerging market areas. So I think that covers most of it. We do expect the Fed and the European Central Bank and the Bank of England to start raising rates. This is just stopping the quantitative easing, raised rates in 2015, which is still a ways off.
Okay. The rates now, I think they're 0.5%, something like that.
Yeah, 0.5 at the policy level in Europe and 0 to a quarter of a percentage point in the U.S. still, target.
And what do you anticipate the level of the rise when and if it happens?
Well, we expect if they start rising the policy rates by 2015, could be earlier if growth is really fabulous next year, but we're not expecting that. That by mid-2016 we'll be in the 4% range for Europe and 4 to 5 for the U.S. So it's still a ways off, but it should get back into this 4 to 5% range. Okay,
would you call that maybe getting almost back?
That would be normal levels, given 2% inflation and 2% a little bit more growth in the U.S.
Okay. Well, now one of the big topics at this year's rendezvous has been the availability and the, I guess some people would call it the invasion of the reinsurance market by alternative sources of capital, i.e. not traditional reinsurers. And I'm wondering, Swiss Re obviously is heavily involved in that, because Swiss Re is one of the pioneers in getting the capital markets to come into the reinsurance industry. Do you think maybe that you got what you wanted, but it didn't work too well, or what's your idea on that?
Well, these things are related, So basically, we've had a very low yield environment, so not just for insurance companies, but of course for everybody else. And so capital has been searching for higher yielding asset types and classes, and we've seen some of that finding insurance or insurance-linked securities, cat bonds we call them, as part of the portfolio that they would like to get into to get higher yields. We've also seen with this alternative capital that the rates implied by the cat bonds and the rates from the reinsurance side have converged. And this meant that those ILS yields are down lower. So there's kind of a limit here for the capital to flow in, because these dedicated funds, which provide, I think, 60% or so of the capital in this space, have a fee they'd like to charge also, which is kind of like similar to our, we'd like a little extra 10% or so for our return on equity out of a pricing just off a risk. And it's gotten so low that they've had to go into lower layers. So it is quite competitive. It is coming in. We estimate, others have different estimates, we get to about 40 billion of capital, which is about 15% of the cat capacity for North America. It's very much confined to the hurricane North America market and retrocession.
It's really property catastrophe.
Yeah, it's property casualty. It's very much U.S. Most of the bonds and collateralized reinsurance, which has grown enormously recently, are in that area, in that space. So it's quite narrow. It doesn't affect all of the market, but we certainly saw it dampen what we thought was going to be a more robust rate increases over the summer in U.S. With the capacity coming in, it started to have price declines instead of staying the same or going up.
Good.
And this is after Sandy, which was quite a significant event late last year.
It most certainly was. Do you see a possible expansion into other lines of business other than property catastrophe?
Well, it's kind of difficult for that to happen. They like the short-term nature of property. Casualty line, for example, you can have, we're paying claims. I was talking to our casualty expert, Jane Plunkett, from 1950. Kind of hard to get your return back on all these, because you have to have the assets. And for example, a collateralized reinsurance vehicle has to stay there until the claims are laid to rest. So it would be difficult. It could happen, but I wonder how long that capacity would last. One thing we like to point out is we've been around for 150 years. The alternative capacity has been around in 15, maybe at the most 20 years if you go back to the earliest cat bond, but really only started up 10 years ago. And will it be around if there's a huge cat event? Will it be around if interest rates rise and they find alternative investment areas that are less unknown and more comfortable to them, corporate credit, for example? So,
sure.
So there's those things are happening also.
Well, there's also everybody is making reference to the solidity of pension funds. That there are pension fund managers. They're not hedge funds, they're not private equity,
right,
and they tend to take a very long time to make investments, but when they do make them, they tend to stay. Is that your view? Well,
pension funds tend to stay, private equity tends to stay. It's a longer term horizon than a hedge fund typically, but their horizon is much shorter than this 50 years of casualty payouts, which is not uncommon. Even on the life side, likewise, it's 50 years or something.
50
so,
years.
yeah.
Wow.
So these things have quite a long duration. That it sounds great as long as there's no event, But if there's an event and there's some casualty mixed in, it can be quite a long time to get the claims. Yes, and so that's what we also like to point out. Of course, our other advantage is in the reinsurance space is. We can help structure deals for clients, and we can make it very specialized and customized, sure, which it's harder to do with a cat bond or the collateralized insurance. It's much more just simple cat capacity as opposed to a tailored, customized solution.
Yeah. On that subject, how does Swiss Re work with like cat modeling firms? I assume you also do your own cat models. What's the process involved in structuring a deal like that?
Like a cat bond?
Well, no, not like a cat bond so much as a big multinational company wants reinsurance.
Okay, on a cat layer. Well, we have our own internal cat model, which is very highly regarded. We don't put it out in the space to compare with RMS and AIR and EcoCat, but we also use them. to benchmark ourselves and get a second opinion on what's going on in a particular cat risk area. So we use those both to price off of, literally, you know, how big is the risk and what's the exposure in this area. So, and we use those, of course, for a cat bond, you have to use an external vendor. You can't use your own model to price off of.
Kurt, you mentioned that Swiss Re's 150th anniversary. It was one of the first reinsurance companies in the world, no? Can you just tell us a little bit about what's gone on over those 150 years, how much it's changed?
Well, I remember them all, of course, sure.
Well, I didn't think you remembered them, but it's part of the company's history.
Sure, yeah. Well, so I think originally we started off on from fire risk, so it was very straightforward, and much later got into the life side, and then later yet, we also have been involved in direct insurance on our commercial insurance side, corporate solutions. So we continue to broaden it out, and we continue to look for new opportunities and new products and new spaces, new kinds of risks that we can insure, because the diversified portfolio is really our strength on a geographical basis as well as a product line basis. So,
okay.
From very narrowly focused to a very broadly focused and very global company at this point.
Swiss Re, how many offices do you have around?
Don't ask me. That's
a lot.
Lots.
lots. I wanted to ask one more question. I assume, I don't know how deeply you get involved in it, but all of the sort of regulatory proposals, the Solvency II in Europe, IAIS standards, NIAC is revamping their stuff in the United States.
Modernization.
Is this necessary? Specifically, I guess, more about whether insurance companies or reinsurance companies can be classified as systemically risky, that sort of thing.
Big is not a bad thing from our point of view. It's a good thing, just as I was mentioning. You have large, geographically diversified as well as product line diversified, and that's a benefit.
Sure it is.
Large, you have your clients have some catastrophe risk, and they offlay part of it to you, so you're like a capital buffer behind them, which dampens systemic risk, frankly, in my opinion. We are interconnected, of course. That's our job, to be interconnected with the insurance industry and support them on the reinsurance side. So a little bit of a puzzle to me that this might happen, but that's just sort of the way it's likely to play out. On the other regulatory front, we see opportunities coming from greater it'll be improvement in risk management, but there's also a lot of capital charges involved in the Solvency II and the Solvency modernization. And there's stresses put on particularly small companies with the compliance, but also the larger companies with juggling their books of business. And in this juggling, sometimes there's some reinsurance opportunities to take off the volatile risk if you're well capitalized, as we are. And as a consequence, there's an opportunity. And there's mergers and acquisitions, runoff, perhaps admin re deals too.
Yeah, because Swiss Re you have a pretty big runoff
division. We pull in runoff deals. We pull in life deals that are like runoff. I'm thinking of P&C, but the life deals are basically runoff also. We bring in the books of business, but it does take 50 years sometimes.
It's amazing to me. Yeah, I know that long-tail liabilities really are very long-tail.
Yes, they can be. Liability, very long-tail, but life is also very long-tail.
Wow. Okay, Kurt, thank you very, very much.
Well, thank you very much.